Hello, and welcome to the Hawkeye Hedge Fund's pitch for the CQA Investment Challenge 2024-2025. We're a student-run investment team from the University of Iowa focused on a risk-managed approach to long-short equity investing. Our presentation today will begin with a brief introduction of our team, followed by discussion of our investment philosophy and process. We will then share details about portfolio construction and how our team approach rebalancing and trading. Lastly, we'll provide some of our portfolio risk characteristics and dive into some specific performance metrics. Let's begin with some introductions. For senior portfolio manager, we have Misaki Nama. For head of trading, we have Kayla Altman. For head of research, we have Landon Skinner. For junior portfolio manager, we have Sean Haggerty. And for chief risk and compliance officer, we have Jane Lamb. Hawkeye Hedge Fund currently manages $2 million in assets, achieving a 7.2% return with a Sharpe ratio over 2 as of March 6. This demonstrates our ability to generate strong risk-adjusted returns while managing disciplined portfolio management. Our strategy is designed for a short to medium-term horizon, allowing us to capitalize on evolving markets while maintaining flexible positioning. We maintain our edge by focusing on absolute returns and staying market agnostic rather than benchmarking to an index. We did this by hedging and staying disciplined to protect against downside risk while optimizing returns. Our investment philosophy is based on a multi-factor approach that combines fundamental, technical, and sentiment analysis to generate alpha. Our process involves a combination of fundamental analysis, assessing macro trends, industry outlooks, government policies, and earning reports. Technical analysis, utilizing momentum indicators, moving averages, entry-exit signals. And lastly, sentiment analysis, tracking retail investor behavior and social media trends to understand market psychology. We structure our strategy dynamically across 3 rounds of competition, adapt to market conditions. I'll now pass to Landon to talk about investment process.
Our investment process started with idea generation. Screeners like Finvista filtered companies on size, value, and momentum. Then we tap into Grok, an AI chatbot, to analyze daily sentiment, identify stocks gaining popularity, and we complement this with brokerage equity research reports from top firms to build a short list of candidates. Next, we dive deep into each candidate, fundamentally assessing industry headwinds and tailwinds, such as growth in renewable energy, alongside macro factors like interest rate trends, and dig into the company's earnings and competitive positioning. Technically, we analyze chart setups, looking at price patterns, moving averages, and RSI for optimal entry points. Sentiment-wise, we cross-check Grok's insights with social media trends to confirm market psychology. This narrows our list to 5 high-conviction trades, which we bring to our weekly team meetings. We discuss each idea, evaluating its risk profile, portfolio fit, and aligning with our absolute return goals. Voting to take positions with an initial sizing of 1 to 1.5% long or short. Finally, we execute using technical signals for precision and monitor positions against our entry factors with clear exit triggers like surprise earnings or sentiment shifts. We process and capture alpha through rigorous analysis and collaboration while staying disciplined, a winning formula for consistent returns. One of the tools we leveraged for sentiment was Grok, which helped us process real-time market discussions, engage investor sentiment on social media. We started by prompting Grok to summarize weekly sentiment. This included identifying key triggers generating buzz on X and assessing whether sentiment skewed bullish or bearish. From there, we analyzed the top mentioned stocks. For instance, Nvidia and Tesla constantly dominated conversations, with Nvidia seeing a mixed sentiment post-earnings, while Tesla remained a bullish retail favorite. We extended this analysis to mid and small cap stocks like Supermicro Computer and Him & Hers Health. Then we classified potential long and short ideas. Stocks with strong positive sentiment like Tesla and Hims were flagged as speculative longs, while names like Nvidia and Coinbase showed bearish sentiment risks. While retail sentiment was not the basis for our investment, the integration of sentiment analysis provided more data when discussing the technical and fundamental factors of our investment. I'll now pass to Sean to cover our portfolio construction.
At Hawkeye Hedge Fund, our portfolio construction is built on informed flexibility. We start with initial allocation of 1 to 1.5% per position, increasing for stocks where our analysis indicated strong potential. As markets move, we adjust dynamically, growing winners and trimming underperformers based on performance and risk signals. Our entry timing is dependent on a broad set of factors, including size, value, momentum, industry, quality, and sentiment, which we evaluate qualitatively to pinpoint high conviction opportunities. Exits are triggered by surprise earnings, macroeconomic shifts, or major sentiment changes, refined by technical insights like breakouts or RSI levels. To protect against downside risk, we follow dollar neutrality, position weight, and portfolio cash balance, which is key to our absolute return philosophy. I'll now pass it over to Kale.
We rebalance our portfolio weekly to remain aligned with the market and our strategic goals. Every week, we assess performance through the three-pronged lens of fundamental, technical, and sentiment analysis. Then we trim underperformers that show sustained weakness while holding or increasing exposure to outperformers with strong momentum factors or macroeconomic support. After this rebalancing, we ensure full compliance with regulatory and competition standards. This weekly process, paired with performance attribution, kept us agile in capturing alpha while staying disciplined and protected from downside risks. A key part of our strategy is aligning with macroeconomic trends to position the portfolio effectively. Shown here are the major themes that shaped our initial investment decisions from the beginning of the competition. With the Fed maintaining interest rates and slowing economic growth, we positioned ourselves with high beta exposure to the US 10-year Treasury, allocated ourselves towards defensive stocks such as consumer staples. Ongoing geopolitical tensions were putting pressure on global trade and supply chains. In response, we increased exposure to energy. Uncertainty surrounding regional banks, especially in a high-rate environment, led us to take a short position in real estate, which is sensitive to borrowing, but we maintained neutral stance on financials to balance exposure. And finally, AI and tech-driven growth opportunities remain strong. We strategically went long in the IT sector, specifically in data centers, semiconductors, and cloud computing. As we progressed through the challenge, it was important to stay up to date with changes in these trends to maintain agility in our strategy. At the start of the challenge, the market was a strong bull run, driven by optimism and growth. Investors were confident and risk-on assets performed well. Because of this, we increased our allocations to high-growth sectors like tech and small caps, and our dollar neutrality was positive, allowing us to capture the upside while diversifying risk. As we moved into the second round, market sentiment shifted due to policy developments and continued AI-driven boom. The Trump trade effect led to rallies in certain sectors, while AI demand fueled strong points gains into data centers and energy. In response, we increased exposure to these industries while maintaining a positive dollar neutrality, and it allows us to capture alpha from the AI rally while keeping an eye on what was a growing macroeconomic risk. In the final stretch of the challenge, we've seen market conditions turn much more volatile. Concerns over tariffs and macroeconomic uncertainty have led to a correction, particularly in small caps and high growth. To adjust, we've reduced our exposure to small caps and increased our short positions in struggling companies. Our dollar neutrality has shifted much more neutral, balancing our long and short positions. This defensive approach has helped us to preserve the capital we generated in previous rounds, while also profiting from targeted shorts in the underperforming sectors. Overall, our ability to adapt to changing market conditions has been critical in maintaining strong risk-adjusted returns throughout the challenge. I now want to pass to Jane to go over our risk analysis and portfolio performance in more detail.
Managing risk is a core component of our investment strategy. Looking at our portfolio's overall risk, we maintained an active risk level of 15.17%, with a historical beta of 0.20, indicating that our portfolio was relatively low beta compared to the market. Breaking this down even further, our active risk decomposition shows that about 63% of our active risk comes from factor exposures, while 37% is a specific risk from individual stock selection. This means that the majority of our risk was systematic, influenced by broader market dynamics rather than idiosyncratic stock-specific moves. To dive deeper, we examined our style factor exposures, which reveal our portfolio's underlying risk drivers. These include momentum, earnings yield, and size, reflecting our focus on high-growth stocks. Conversely, we maintained lower exposure to factors like leverage and value, which helped manage downside risk in volatile conditions. Sector-wise, our largest active risk sector comes from information technology, which aligns with our strategy of capturing growth from AI-driven momentum. Meanwhile, we minimize exposure to real estate and consumer discretionary, which were more vulnerable to macroeconomic uncertainties such as interest rate hikes. Over the 4-month competition period to March 6th, our portfolio delivered a 17.15% return, significantly outperforming the S&P 500. With a Sharpe ratio over 2, we demonstrated strong risk-adjusted returns, balancing upside potential with disciplined risk management. Among our best-performing positions were our long trades on Hims & Hers and Robinhood, both of which capitalized on momentum and favorable sentiment. On the short side, Wheeler was a standout, as it underperformed in line with our thesis on weak fundamentals and market pressures. While we had strong winners, there were also valuable lessons. A long position in Transmedics underperformed due to unexpected headwinds, while our early short of Duolingo did not decline as anticipated, limiting our gains on the short side. These cases reinforce the importance of adjusting exposure dynamically and closely monitoring position catalysts. The chart on the right shows our 3-month return versus the S&P 500, where we consistently outpaced the benchmark. The cumulative P&L by sector further highlights where our strategy generated the most value across different industries. Overall, our portfolio success stemmed from a dynamic, data-driven strategy that capitalized on macro trends, market sentiment, and technical indicators. By refining our execution and risk management, we positioned ourselves for strong alpha generation throughout the competition. Thank you very much for your time.